Light.
Hey Dave, good to be back.
John, very happy to have you back. And Friday, we came out with these job numbers, and they're out there, the corporate media, the government, they're all telling us how great the economy is doing. The job numbers are fantastic. The unemployment rate didn't really fall, it stayed steady at 4.9%. When you look at the job numbers, is the economy back on track? Is everything fine right now?
Well, there's a recurring pattern with our jobs reports where the headline number is really good, and most of the media just takes the headline number and runs with it, and then the markets react accordingly for a little while, and then analysts take a look at the numbers, the underlying numbers as the government releases them, and we all find out that not to put too harsh a term on it, but the numbers turn out to be kind of bogus, or at least the headline number does. Normally, what happens is that you get a really good headline number, and underneath, it turns out that most of the jobs that were created were part-time jobs. Most of those jobs went to people over the age of 55, and most of those jobs were bartender and waiter jobs. So yeah, lots of people are working, but they're working at crappy jobs that have nothing to do with the career, don't pay enough to support a family, and really weren't what these older workers were expecting to be doing at this point in their lives. So it really, under the surface, illustrates a deteriorating economy. This time around, it was a little bit different, though. The big change, the big positive change that gave us this great top line number was because of a seasonal adjustment that was way bigger than usual. Normally, you get a seasonal adjustment that is X number of jobs added or subtracted at this time of year. This time around, it was this massive increase in jobs for some reason, unexplained reason. And if you take that out, it wasn't a very impressive jobs report. So the bottom line is that the U.S. really isn't doing as well as these top line government numbers would lead you to believe. And that's why, we have an unemployment rate that's in the 4% range right now. Normally, that would be a sign of extreme overheating in the job market, which leads to massive increases in wages, which leads to inflation, which destabilizes the system and leads the government to aggressively increase interest rates to try to slow things down. And this time around, the Fed is very reluctant to raise interest rates, and that's why they're reading the numbers more or less correctly and interpreting the job trends as a sign of weakness rather than strength. And so they'd love to be able to raise interest rates to help the big banks, because banks can't function very profitably with interest rates at these low levels. And it's worse in the rest of the world where interest rates are negative, but it's still pretty bad here for our big banks. They are screaming at the government to get interest rates back up somehow. And so the Fed would like to do that because they're owned by the big banks. People don't necessarily know that, but the Fed is basically a private entity that is owned by the major banks in the U.S. So they want to raise interest rates, but they understand that the real unemployment rate, the real conditions in the labor markets are actually pretty unfavorable, and they're not really improving. And so they're hesitant because they're afraid that anything they do to increase interest rates will lead to instability in the financial markets and could easily push the economy back into a recession, which we might not be able to recover from. Somebody else coined an interesting term this week, which is the too big to fail stock market. And the implication is that our financial system is so overleveraged and so fragile that we might not be able to survive a garden variety 20% bear market decline in U.S. equities. And so the central bank and the government in general are doing everything they can to prevent any kind of a normal cyclical or just technical downturn in equities. They're in there buying stocks and keeping interest rates low and promising all kinds of new QE if anything bad happens, and implicitly promising to bail out whatever big institution gets into trouble. And in that way, they're elevating asset prices. But the cost of something like that, where you artificially increase asset prices and manipulate markets, is that the markets don't work as markets anymore, and they're just big manipulations. And so capitalism is basically just a bunch of markets sending signals to capital allocators, to entrepreneurs and to corporations and to savers about what to do with their money. And when you hamstring that process, the wealth creation machine, which is what capitalism is when it's firing on all cylinders, it stops working. And that's really where we are now. That's why we can borrow more and more money year after year and not get much of a bang for those bucks, because we, first of all, have borrowed so much that it makes everything hard. And second of all, we're manipulating the market signaling mechanism in a way that that causes it not to work. We don't know where to allocate our capital. If you're a saver, you have no idea where to put your money, because if you put it in the bank, you get next to nothing. You put it in the stock market, you take excessive risk. And so there's kind of a no-win situation for you there. If you're a corporation and you build a new factory, you have no real sense that the stuff that factory makes is going to find a market when the time comes. You just can't know. And so that's why corporations borrow money and just basically just buy back their stock now in the US. And that's why individuals are withdrawing from the stock market, because they're terrified of the risk that implies. But they're also pulling their money out of bank accounts because they don't earn anything in the bank, and they're afraid the bank is going to fail and there's going to be a bail-in or capital controls or something. And so you get markets that involve people playing games with their money rather than productively investing. And that's what we're headed for here. And the outcome of that is going to be really bad, because we've got so much debt to carry that if we can't carry it by producing more and more wealth year after year, there's a financial crisis coming that will make the 2008-2009 near-death experience look like a walk in the park.
So you mentioned a lot of things, interest rates, the stock market. We're not going to do very well if the market comes down. I just wanted to start off with the interest rates with the Fed, because they continually tell us they're going to increase the interest rates. And you said that the banks are screaming for higher rates, but we see like Bank of Japan, we see the European Union, they're all negative rates. And you just mentioned that the job numbers, they're massaged, manipulated, and they really know the jobs are much worse than they are. So where does the central bank go right now? Can they actually raise the rates? Is it possible? Or do they have to follow the path of the Bank of Japan and the European Union and go negative?
Well, they want to raise rates because their bosses are telling them to do it. But the risks that come with being the only central bank in an over-leveraged world to raise interest rates when everybody else is cutting interest rates must terrify them. Because one of the consequences of us raising rates would be, other things being equal, to make the dollar stronger, right? And see, that's a bad thing if you're an over-leveraged society, because a rising currency exchange rate means that you got to pay off your debts in a more expensive currency. In other words, it's harder to pay off your debts. And if you're already having trouble paying off your debts, making your currency go up and making the debts harder to pay off is a loser's game. You know, it leads to some kind of a crisis where lots of people start defaulting because they can't cover their debts. Governments start defaulting because they can't pay their bills. And you get a gigantic crisis. That's what it means to lose the currency war. And so that's our situation right now. So the Fed would like to raise interest rates because that will allow JP Morgan Chase and Goldman Sachs to make more money. And then the Fed officials can go back to work for the big banks later on at multiples of their government salaries. And so in effect, what being a Fed governor is a job interview for the later job when you make the real money. And so those guys know who pays their bills ultimately, and they want to raise interest rates. But the whole rest of the world is cutting interest rates because they are absolutely terrified about the consequences of their past mistakes. You know, Japan has borrowed more money at the governmental level than any other country in the history of the human race relative to their economy's size. China since the 2008-2009 crisis has borrowed more money than any country has ever borrowed in that space of time, and they wasted a lot of that money. So they've got a huge crisis. Europe obviously is in chaos right now because half the countries in Europe are on the verge of electing people who don't want to be part of the European Union anymore, with good reason. It's a mess. It's a bureaucratic monster, a terrible place to live. And so everybody is in one form or another of a crisis. And historically, governments and especially central banks have responded to crises with easier money and lower interest rates. So that's the only tool they've got in their toolbox. And so they respond to everything with that. But it's stopped working now because once you push interest rates down below zero, you start distorting the market in ways that is only understood theoretically, or has only been understood theoretically until just lately. Now we're trying it in the real world, and we're finding out it doesn't work. It's even worse for the big banks in, for instance, Japan, to have negative interest rates, because then they can't make any kind of money. Or the same thing with insurance companies and pension funds, and most of the financial sector just flat out can't function in that environment. And here's where it gets really interesting. Japan, for instance, cut its interest rates across the board to negative levels, but its currency went up. See, normally when you cut interest rates, you're ultimately trying to make your currency less valuable because people don't want to invest in your bonds if the interest rate goes down, other things being equal. Japan found out that by lowering interest rates, they got a higher, more valuable currency, and that is crushing their export industries. So they can't sell stuff to the rest of the world with a more expensive yen. And so their exporters, who are really the central force in their economy, are having trouble now. So you got big banks suffering, and you got the exporting industry suffering. And where do you go from that if you've already cut your interest rates to negative levels? That's the kind of crisis that the whole world faces right now in various forms. And there really doesn't seem to be a solution because these guys just have that one tool. They have easy money as their response to pretty much everything. Like the old saying where if your only tool is a hammer, every problem looks like a nail. Well, for these guys, every problem looks like a slowdown that requires easy money. And, it's not clear where we go from here because we've never taken that policy prescription to its logical conclusion, and as we've done this time around. And so I have no idea what happens next. I'm sure they'll try some variation of easy money, like a debt jubilee or a guaranteed income or massive infrastructure spending program. And that will fail. Whatever they try will fail, because if something like that worked, where you just print a whole bunch of money and give it to people and everybody gets richer because they've got more money, that would have been done successfully 1,000 years ago. And that's how everybody would live now. But every time something like that has been tried in the past, has failed miserably, led to a gigantic crisis that frequently led to regime change in which a dictator came in. That's where Napoleon came from. That's how we got Hitler. And it goes on and on. And so we're trying that again. And that's what's so scary about today's world, is that we're not only trying stuff that has been an abject failure in the past, but we're doing it on a global scale in a bigger way that's ever been done before. So the world that we're creating is terrifying on a lot of different levels. And you would think that the guys in charge who are pursuing these policies would understand the damage that they're causing, but they don't seem to. They're locked they're locked into an intellectual framework and a set of analytical models that don't reflect reality. And so they're trusting their models rather than real world data coming in. And so the real world data scares them, but they still trust their models to fix things. And so they're going to go even further. And when the failure comes, as it inevitably will, it's going to be bigger than anything we've seen before.
So you talk about like the real world indicators. When we look at let's say GDP, when we look at what's really happening in retail, when we look at the real unemployment numbers, when we look at housing, when we look at, manufacturing, factory orders, we see a completely different picture. I mean, on one hand, we see the stock market continually going up and up and up and up. Sometimes it comes down a little bit, but most people look at this and say, oh, look, the economy's doing well, everything is fine. And then we have the other side, which is not mentioned that much in the corporate media, by the government, on how the economy is really doing, because we're seeing a lot of things contract at this point. Do you see similarities between today and 2008?
Oh, sure. But 2008, I mean, that was a financial bubble when the government responded to the previous crisis by cutting interest rates aggressively and printing a whole lot of new currency and giving it to the markets. And you got an asset bubble centered in U.S. real estate.
Mm-hmm.
And that was big enough, given the derivatives that were being written on U.S. mortgages and stuff like that. That was big enough to almost destroy the global financial system. But what we've done since then is vastly bigger. You know, we responded to the bursting of the housing bubble and the derivatives crisis in the U.S. basically by doubling down. You know, we cut interest rates even further. We ramped up government deficit spending even more. And we gave the big banks even more ironclad guarantees that they would be okay no matter what they do. So basically, everybody in the financial system responded the way they normally do to basically socialization of risk and privatization of profit. You know, we told traders, you know, go ahead, take any kind of risk you want, reap the rewards of that. If you're right, you make a fortune, but if you're wrong, we'll bail you out. And so, you know, they responded rationally, given the situation that they're in. And the whole world this time around, instead of just the U.S., has gone that route. You know, everybody has ramped up their borrowing and their excessive malinvestment and their financial speculation. And so it's not just a localized bubble anymore. You know, the past bubbles that caused pretty serious damage to the global economy were in junk bonds in the 1980s, which were just a kind of little financial niche, and then tech stocks in the U.S. And that was a bigger niche, but still not a global phenomenon. And then housing, which was bigger still in terms of the numbers of risk capital that was deployed at the time. And still, they were all localized bubbles that when they blew up, they mostly crushed that one industry, you know, and everybody else who happened not to be involved in it, they weren't necessarily hurt directly by it. Well, this bubble is our money. We're inflating away the world's major currencies, and we're doing it via government debt. Every government in the world is increasing the amount of debt that it's got out there exponentially, and then its central banks are buying back that debt on the open market with newly created currencies. So basically, we're just starting to finance a debt binge directly by creating new currency and pumping it out into the system. And that, historically, that kind of debt monetization is the final stage before a gigantic financial crisis hits. You know, you have a hyperinflation or a 1930s style deflationary depression, or you get the crack up boom that the Austrian School of Economics talks about, where everybody just flat out gives up on the currency because they figure out that the government's explicit policy is to make that currency worthless year after year after year. So they just start dumping the currency. And then you get something that looks like a hyperinflation, but which is really just a loss of faith in the currency. Stuff like that is coming, but instead of coming within a given country, acting on a stage of a sound currency world, there is no sound currency world anymore. Everybody's operating with a fiat currency that is just whatever the government says it is, and they're creating too much of it by historical standards, and they're encouraging people to borrow too much money by historical standards everywhere. You know, it's Europe and Japan and the U.S. and China and in most parts of Latin America. So wherever you look, you see an incipient financial crisis. And the question then becomes, when does it hit? You know, when does this all blow up on us? And that's what we can't know, because we don't know what they're going to do next. You know, the governments are probably going to come out with some new plan, and, you know, they're going to have sober guys wearing business suits on TV talking about this stuff, you know, about the debt jubilee or the loan guarantees or the new guaranteed income, as if they understand what they're doing. And it's going to sound reasonable to people who aren't really paying attention. So the question is, do we get one more go round with the new set of policies that push stocks up to even higher levels and bond yields even lower, and or does everybody figure it out and act in ways that are the opposite of what the government is hoping? And does the system blow up then? You can't know, because we've never been here before. And someday it's going to blow up, and maybe this time around is the time that it blows up, but there's no way to know. So we're reduced to being bystanders in a lot of ways, the sound money community. We're just watching this train head off the cliff, and there's no real way to know exactly when it goes off the cliff, but it's going to happen sooner or later.
John, you mentioned the economy turning down, blowing up. Now, when this happens, and I think many people are wondering and saying, okay, I have all these dollars, I have them in my bank, I hold them, I use them. What happens to the dollar if this time around they can't save the system?
Well, that's the big question, because we've never been here before. We've never borrowed this much money and lied about it this blatantly and financed so much of it by just printing new currency globally. Lots of countries have done this on their own in a world where other countries weren't doing it, and they blew up. Their currency collapsed in value, and they had political turmoil in which somebody new came in, and they either fixed it or they didn't fix it. But it was fairly well contained within that country. And this time around, it's everywhere. So who knows? There's really no way to know what happens here. I mean, it's going to be chaotic, but will it be strictly a financial phenomenon where currency values plunge and financial asset prices bounce around in a way that's completely unpredictable, and then everyone comes together and does a currency reset, for instance? That would be the best case scenario. Jim Rickard's idea that eventually the world is going to figure out that they can't devalue against each other's currency because that's a zero-sum game. There's a winner and a loser, but everybody can devalue against gold. So we go back to a gold standard with the dollar worth 1/10,000th of an ounce of gold, and go forward in that way with a sustainable monetary system. Well, that's the relatively painless scenario. And there are a lot more painful worst case scenarios in which we have a financial crisis that leads to a global political crisis, which leads to a global depression that we can't get out of for a really long time because we've got to get rid of all this debt, or we have some kind of a war because governments decide to try to distract their voters from their own mismanagement by picking on a distant enemy, and that leads to some kind of a war. That's also something that's historically normal. And we're seeing signs of that all around the world, right? The whole Middle Eastern thing where for no good reason, we keep intervening over there and keep invading those countries. And the demonization of Vladimir Putin, who, not that he doesn't deserve to be demonized, but it seems to be a very convenient time and place for the U.S. and the European governments to do that. And then we've got China and Japan and the U.S. bumping up against each other in the South China Sea. And I'm sure part of that involves legitimate territorial claims, but a big part of it is probably governments being okay with distracting their citizens from the mess at home by pointing to some kind of a crisis that's bubbling up overseas. Well, you know what? Any of these things can go from a public relations strategy to a shooting war really easily. And so that's the risk that we run, where some fighter pilot panics and blows a ship out of the ocean or another plane out of the sky, and things start to spin out of control. So this is the kind of thing where you've got so many moving parts and so many big risks that it really is impossible to say how it all plays out. But it won't play out happily. That's the thing to understand, that none of this can be fixed painlessly. We just have to go through various kinds of pain, and we won't know what kinds of pain we have to go through until it actually happens.
So you mentioned war. Now, I mean, if they use war as a distraction, does that fix the economic problems, or are we still going to go through the economic pain?
See, what's truly crazy about dominant Keynesian economic theory is that they think any kind of government spending is good because it causes people to buy stuff, and people buying stuff is inherently good. And so for them, a war is actually, they look back at the Great Depression and say, well, World War II pulled us out of the Depression. And Paul Krugman, a Nobel Prize winning economist who writes for the New York Times, has actually said that alien invasion would actually be good for the global economy because it would get government spending again. And so for Keynesians, some kind of a military confrontation actually has an economic upside. And to me, that's just insane. There is no economic upside to borrowing a huge amount of money and buying a bunch of tanks and planes and then blowing those tanks and planes up in a fight with somebody. That is not economic growth in any rational sense of the word. But the guys in charge don't necessarily see it that way. They see it as an excuse to ramp up government spending, which to them is a good thing, no matter how you slice it. So, no, I don't think a military crisis or a geopolitical crisis would be a good thing for us in any way, shape, or form. But I think it's possible because historically stuff like that comes along with financial crises, and after the French Revolution in the 1700s, the new government that came in had a hyperinflation. They basically destroyed their currency in order to finance a bunch of really grandiose plans. And then the system collapsed and they got Napoleon. And then there were several decades of pan-European war because Napoleon was trying to take over everything in sight. That's the kind of thing that frequently happens after financial crises. And we should definitely be worried about a financial crisis, but the geopolitical knock-on effects of a currency crisis and a stock market bear market and bond crisis should be the thing that really worries us. I have a couple of draft age sons, and so this prospect just terrifies me. The idea that we're going to screw up in a way that leads us into some crazy war that makes no sense, but in the moment we can't back down because then we'd lose our respect around the world. Something like that, which is the rationale of the right in the U.S., that no matter what mistake we make, we've got to back it up with force because otherwise we won't be respected. And that leads them to take my kids and send them to the Middle East or Asia or someplace that terrifies me. I hate that idea. And that's the truly scary part of what could be coming.
When this system finally breaks down, is the United States going to experience maybe something like Venezuela is experiencing now, where people are running around trying to find food, supplies? Do you see that scenario here in the United States where credit's going to freeze up and it's going to be very difficult to get your everyday supplies?
Well, at the beginning of the 2008-2009 crisis, the big banks told George W. Bush that we were a few days away from martial law. And that's the thing that terrified him into caving and bailing out the big banks with trillions of dollars of taxpayer money. And yeah, when you have a really serious financial crisis in which you mismanage your money to the point where it doesn't really work well as money anymore, then you get supply chain disruptions. It gets harder to buy stuff. And it's because companies aren't able to project into the future the results of their actions, they kind of pull back and they get really cautious, and it's, the store shelves get more and more bare. That kind of thing can happen. It's a little hard for me to imagine it happening in the US just because we're such an agricultural powerhouse. We produce an awful lot of food. And the idea that food, once produced, won't make it to grocery stores it's hard to imagine, but historically, stuff like that has happened over and over again in countries that screw up their finances. So we can't rule something like that out. I don't think that's the biggest risk. I think your biggest risk is that you lose your job because your company is affected by the global financial crisis, and that's why you can't get food, because you don't have any money coming in, but there's still food out there. And other stuff that you might want to buy, gas for your car, et cetera, but you're not working, so you can't buy those things. And also that your investment capital, your nest egg, is affected in some really serious way because you have it in the wrong place when the markets spin out of control. If you've got large cap stocks in your portfolio, you've been doing great for the past, really the past 70 years since World War II. That was just a great place to have your money. But if we have the kind of financial crisis that has happened in the past to countries that take on too much debt and then have a deflationary depression, your stocks are going to go way down. So not only will you possibly lose your job, but your nest egg might evaporate too. Or if you've got a bond portfolio, got a lot of bond funds in your 401k or whatever, and we screw up the currency and bonds have a huge bear market, then you're screwed too. So there are a lot of different levels to be concerned about here. And the big risk, I think, from our point of view, leaving aside of World War III, that's an unpredictable thing that if it happens, it makes all of the rest of this stuff pale into insignificance. But on the financial side, the perfect storm is what I would worry about if I was, most people, where you lose your job and your investments evaporate at the same time. And so then you're stuck with almost literally nothing after a lifetime of saving and hard work. And, that happened during the Great Depression to an awful lot of people. That's why you had this spike in suicides then, because people lost everything. People who had a lot lost everything. And we're creating conditions in which something like that could happen again. So you've got to be really careful about, everything. Pay off as much debt as you can so you don't have loan payments that you've got to make, and if you can't make them, the repo man comes and takes everything. And make yourself as indispensable at work as possible so you're one of the last people to get laid off if layoffs come. And set up your savings and your investment program so that you're not overly exposed to financial assets that are going to be the really volatile things when the financial markets start spinning out of control because of all the debt we're taking on. And, the standard advice for something like that is to focus on real things like gold and silver, which are kinds of money that governments can't create in infinite quantities, and really, really well-chosen, for instance, pieces of real estate, like a good rental house in a college town that's fairly stable. That's probably something that's going to maintain its value over time. And possibly energy assets like oil wells and things like that tend to hold up pretty well. And avoid things like long-term government bonds that might do well if we push interest rates down another notch, but are at incredible risk of volatility in the financial markets when the consequences of negative interest rates really start to bite. So, and none of this is foolproof, and there is no perfect way to structure your finances in a world that's spinning out of control like ours might be. But diversifying among real things is probably your best bet, and going as debt-free as possible. That's always pretty good advice, but it's more so now when you just can't predict what's going to happen. And so you want to have as much dry powder as possible and as few obligations that carry risks with them as possible.
John, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
Well, I run dollarcollapse.com. That's the best way to check in on what I'm up to. And, it's a continuously updated site that covers the stuff we talked about. So the idea is go there for an hour in the morning and you're pretty much up to speed on the gloom and doomy side of the world.
Hey, thank you very much for being on the Spotlight. I really appreciate it.
Thanks, Dave.
Thank you.